They say nothing in life is certain except death and taxes. Well, in the world of investing, you can add a third: market crashes. Just when you think you've seen it all, markets throw up another curveball. But here's the good news. What if I told you that the best time to build serious wealth is when everyone else is losing their minds? When you see those scary headlines about market crashes, when your portfolio is glowing red, and every part of you is screaming, "Sell!" What's the right move? Most people panic. They sell, they lock in huge losses, and they turn a temporary dip into a permanent disaster. The world's best investors do the exact opposite. They don't just survive the chaos, they use it. And you can learn the simple, powerful strategies they use to come out of a downturn richer than they went in. Let's get one thing straight. Market crashes are scary. It says completely normal to feel that knot in your stomach when you see thousands of dollars seemingly disappear from your account overnight. But the single biggest mistake you can make is acting on that fear. Warren Buffett has a simple rule: be fearful when others are greedy, and be greedy only when others are fearful. During a crash, fear is everywhere, and it can grip even the most experienced investors. But this is the moment of maximum opportunity. Think about the 2008 financial crisis or the sharp drop in March 2020. The news was terrifying in both cases. People who sold their investments at the bottom turned a paper loss into a real one, permanently. But those who held on, or even better, kept investing, saw their portfolios not only recover, but surge. Using an S&P 500 calculator and assuming reinvested dividends, a $10,000 investment made at the market's low point in 2008 could have grown to over $50,000 by 2025. Here is the truth. You haven't actually lost any money until you sell. A market downturn is temporary, but selling is permanent. And if history has taught us anything, it's that markets eventually recover. The key is to have your strategy ready before the panic starts. So if panic selling is the absolute wrong move, what are the right ones? Let's walk through the smart, actionable strategies that separate savvy investors from the rest. First, adopt the everything is on sale mindset. Imagine your favorite store suddenly announced a 30% off sale on everything. You'd rush over to buy things you've wanted for a while, right? A stock market crash works the same way. Great, fundamentally strong companies are suddenly available at a huge discount. This is the whole idea behind value investing. A falling stock price isn't a crisis. It's a chance to buy a wonderful business for a fraction of its real value. During the 2008 crisis, Warren Buffett invested billions into solid companies that were getting hammered by panic. Those investments paid off spectacularly. The key isn't to buy just anything that's falling. It's about buying high-quality companies with strong financials, consistent profits, and a real competitive edge. A crash lets you buy a piece of the future at a clearance price. If picking individual stocks during a crazy market sounds overwhelming, there's an even simpler, more powerful strategy: dollar cost averaging, or DCA. This is about keeping calm and investing on autopilot. You invest a fixed amount of money at regular intervals, say $500 every month, no matter what the market is doing. When prices are low, your fixed dollar amount automatically buys more shares. When prices are high, it buys fewer. You don't need to time the bottom. The real power of DCA is that it removes emotion and keeps you consistent. Over time, this steady discipline means you're always buying low, setting yourself up for great gains when the market recovers. By the way, if you're finding these strategies helpful and want to build a truly resilient long-term portfolio, I've got a free newsletter that breaks down investing concepts just like this every week. You can sign up using the link in the description. Another powerful tool during a downturn is rebalancing. Let's say you have a portfolio that's 60% stocks and 40% bonds. After a crash, your stocks might drop so much that your portfolio is now 45% stocks and 55% bonds. Your carefully planned asset mix is now way out of balance. Rebalancing means selling some of the assets that held up, like bonds, and using that money to buy more of the assets that fell, like stocks. This might feel backward, but what you're really doing is forcing yourself to sell high and buy low. It's a systematic, rule-based way to take advantage of crashes while keeping your risk aligned with your long-term goals. Finally, remember the safety-first rule. During a roaring bull market, it can be tempting to use leverage, borrowed money, to juice returns. But during a crash, leverage is a financial time bomb. It magnifies your losses and can wipe you out completely. That's why one of the smartest moves you can make is avoiding debt and keeping cash ready. Buffett is famous for keeping billions in cash, waiting for the right moment. For the average investor, this means having an emergency fund, 6 to 12 months of living expenses, so you never have to sell your investments to cover an unexpected bill. And if you have extra cash, a crash is the perfect time to put it to work. So, are market crashes the best time to invest? For the disciplined, long-term investor, the answer is yes. While everyone else is panicking, you now have a playbook. 1. Adopt the everything is on sale mindset. 2. Use dollar-cost averaging to invest on autopilot. 3. Rebalance your portfolio to systematically buy low and sell high. And 4. Follow the safety-first rule by avoiding debt and keeping cash ready. Market crashes aren't a matter of if, but when. They're a natural part of the investing cycle. By seeing them not as a threat, but as an opportunity, and by having a plan, you can turn moments of widespread fear into your greatest chances to build wealth. If this video helped you look at market downturns in a new light, hit that like button and subscribe for more content to make you a smarter investor. And I've got a question for you. What you want for? What is your biggest fear when it comes to a market crash? Let me know in the comments below, and let's talk about it. Thanks for watching, and I'll see you in the next one.